Takaful Islamic Insurance. Takaful, an Islamic alternative to conventional insurance, is a cooperative risk-sharing arrangement. Unlike traditional insurance, where policyholders pay premiums to a company for coverage, Takaful operates on mutual assistance, where participants pool their contributions into a collective fund used to cover potential losses. Takaful aligns with Islamic principles by eliminating riba interest, gara excessive, uncertainty, and mazy gambling, focusing instead on ethical and transparent risk management, risk sharing, and mutual assistance, most common forms of Islamic finance contracts. Participants' policyholders contribute to a fund with the understanding that they will assist each other in times of need. When a participant suffers a loss, the collective fund covers the claim. This cooperative model creates a community-based approach to risk protection, embodying the Islamic principle of Tawan mutual cooperation. No profit motive on claims. In Takaful, the insurance operator manages the fund but does not profit from the claims paid. Instead, any surplus in the fund after covering claims and expenses is often distributed back to the participants, unlike conventional insurance where the company retains all profits. Ethical investments. Contributions are invested in Shari'ah-compliant assets. The Takaful operator ensures that funds are invested in projects and assets that align with Islamic ethics, avoiding industries like alcohol, gambling, and speculative markets. Transparency and participant ownership. The Takaful fund belongs to the participants, and the operator serves as a trustee wakil rather than the owner. Transparency in fund management, claim payments, and investment activities is central to Takaful, providing peace of mind and a sense of ownership among participants. Takaful Participation Agreement. This contract outlines the responsibilities of the participants, the nature of contributions, and the risk-sharing arrangement. It also details how claims will be handled and the cooperative nature of the fund. Example: a participant joins a Takaful plan by agreeing to contribute $500 annually to a health Takaful fund, which covers medical expenses for all members. 2. Wakalah Agency Agreement. The Wakalah Agreement appoints the Takaful operator as the agent or trustee responsible for managing the Takaful fund. It details the operator for managing the fund, which are often drawn from the pool of contributions. For example, the Takaful operator is appointed to invest the fund contributions in Shari'ah-compliant assets, charging a management fee of 2% of the fund value annually. Claim Settlement Agreement. This agreement specifies the terms for processing claims and distributing funds to participants who incur losses. It includes conditions for eligibility and details on how payouts will be calculated from the collective fund. Example: if a participant incurs a covered medical expense, the Claim Settlement Agreement ensures they receive reimbursement from the Takaful fund based on the policy terms. Surplus Distribution Agreement. If a surplus remains in the fund after claims and expenses are covered, this agreement governs how it will be distributed back to participants or retained for future use. Surpluses may be redistributed proportionally to participants, supporting the cooperative nature of Takaful. Example: at the end of the year, the Takaful fund has a surplus of $50,000, which is shared among participants or carried forward to reduce next year's contributions. AOIFI Guidance. Shari'ah Standard Number 26 Islamic Insurance Takaful. IFI guidelines for Takaful emphasize mutual cooperation, ethical investments, and transparency. Standards include clear risk-sharing arrangements, Shari'ah-compliant investment policies, and the requirement for transparency in fund management and surplus distribution. The standards ensure Takaful remains a fair and equitable system, aligning with the ethical values of Islamic finance and providing participants with a sense of security and communal support.